Tuesday the 16th, good morning, welcome. I'm Guy Johnson. I'm alongside Kriti Gupta today. Tom Mackenzie's here as well. We're about an hour away from the opening trade. What do you need to know this Tuesday morning? Well, Trump picks Ohio Senator J.D. Vance as his running mate. What could the isolationist former US Marines' views on Europe and China mean for markets? We'll discuss that. France's left struggling to find the right candidate for Prime Minister. Talks between the parties forming the Nouveau Front Populaire appear to have broken down. We're going to speak to Socialist MP Philippe Brun for the latest on that story. We're going to get the inside track. And back to luxury. Hugo Boss misses estimates, cuts its full-year sales forecast. Cartier maker Richemont meets Q1 estimates, but it's seen a sharp slowdown in Asia, Kriti.
I wonder how much of that is feeding into the overall market dynamic. When you look at the markets here, you are seeing futures pointed to the downside. Eurostoxx 50 futures down 0.5%. FTSE 100 on the back foot as well, down by 0.3%. The currency markets are interesting, though, because you are seeing them hold steady at that level. 129.59 on cable, 108.88 on euro dollar. The countdown to the opening trade starts right now.
So, Tuesday the 16th, what have we got to discuss? I think politics remains front and centre. Powell, to a certain extent, I think, is on the docket as well. We'll talk about what's happening with the central bank story. And earnings remain absolutely front and centre. The luxury stocks here in Europe, the dominant story, I would argue, throughout the session this morning once again. But let's start with politics and think about exactly what impact J.D. Vance is going to have on this US election and US policy were the Republicans to win. Kriti, this is a huge story in so many ways. Trump has been keeping us guessing as to who it ultimately will be. He fits the Trump mold, definitely. What does it mean for Europe? What does it mean for Asia? What does it mean for China specifically? I think some really big questions are being asked this morning in these areas.
So he's parroting a lot of the foreign policy kind of picture that President Trump had wanted as well. Remember, he's really looking to echo, President Trump's really looking to find someone who echoes a lot of his views, because Mike Pence didn't really do that in a lot of different areas. So he's really looking for someone who, one, also appeals to the Rust Belt as well. So within the domestic politics, really appealing to kind of the northern crowd. He tried to get the UAW endorsement out of the kind of labor movement out of Stellantis, etc. Wasn't able to secure that. They ultimately ended up backing Biden instead. But this is kind of his way of appeasing that blue-collar crowd, but then also trying to go tough on China, trying to pull out of Ukraine. And that's the messaging that J.D. Vance has.
How much has the transformation around J.D. Vance been about positioning himself for VP versus his genuine, strongly held beliefs? Because this is someone who came out and described Trump as noxious when Trump was running for president first time round. Is this a J.D. Vance who believes all of this stuff, or is this someone who is deftly adjusted to the political reality of the US?
It's a good question to ask, and I would say it goes in a two-way street, because J.D. Vance, from a domestic perspective, is also someone who appeals very largely. Remember, he came to prominence and even got a seat in the state legislature, for example, as senator, because of his best-selling novel called Hillbilly Elegy, so where he's really appeasing to what a lot of people would call the MAGA crowd, the Appalachian crowd, et cetera, and kind of making the point that there is a way to break out of that mold and come from a background that isn't as wealthy and come from kind of the MAGA crowd, but still make it in the likes of Silicon Valley.
So, yeah, because he's got a VC background as well after the Marines. What does it mean for Europe? He's clearly got very strong views on what's happening in Ukraine. He thinks that can be resolved very, very quickly. What does it mean for European defence spending? I think it probably means that Europe should think seriously about maybe spending a little bit more, or anticipating having to spend a little bit more. What does it mean in terms of trade? I think China's the front and centre story there, Tom. This guy comes in and he has influence over Trump, and that we don't know yet what level of influence he would have, but potentially he could be pushing some very strong tariff lines down the China route. And you wonder, once again, what impact that could have. There's a UBS report out this morning talking about a huge impact on Chinese growth.
Yeah, 2.5% cut to GDP, to Chinese GDP. And that's if you assume that China doesn't retaliate. China would retaliate if you put 60% tariffs, additional 60% tariffs on the tariffs that already exist in terms of Chinese exports to the US market. So that's the analysis from UBS. Fortunately, Guy, of course, Europe has its house in order, and so they are well positioned to adjust to a more protectionist US. Of course, that is not the case. We see what's happening.
I was about to say, how serious are you?
In France,
He's not.
In France, with the caretaker government expected to come in, Macron has to make a decision by Thursday. Gabriel Attal, the Prime Minister, has officially handed in that resignation letter. So it seems you're going to get a caretaker government. And what is also happening, and this is not a big shock, if you've been looking at the makeup of the hard left, or at least the leftist grouping, who got the most votes, but not that majority, is that there are now splits there between the socialists and France Unbowed, and so they cannot make a decision on who to put forward as Prime Minister. Does that play into Macron, though? Is that a benefit for Macron? Is that
really
market
positive?
positive?
Isn't it? We don't know yet.
Yeah.
Ultimately, the far left, Mélenchon, is basically saying the socialists are vetoing all of his candidates.
Yeah.
That we can't find common ground. Will they ultimately find common ground remains to be seen. How long does the caretaker government kind of stay in place? Is it post the Olympics? Does it kind of drift into the autumn? It's really hard to tell at the moment. But there was always expected to be chaos around this grouping of left-leaning parties, either some real extreme left-leaning parties.
Yeah.
But you think about it from a policy point of view, you've got to assume that the pension reform is off the table. And we are going to see a lot more government spending.
And even with that reality, markets are still kind of taking it in stride. They're still kind of trading off this political deadlock is a positive for markets. You can see that, I think, most clearly in Eurodollar, which is still staying about 108. Every single France headline now. I feel like I'm conditioned to see some sort of pullback, and yet I don't see it in futures trading, in the bond market, or even in the stock market.
I think once the policies start to form, once we start to see the clarity around potential wealth taxes,
pension reform, etc.
Pension reform or lack of reform and spending and all of those things, once they start getting put in place, that's when maybe we start to see the impact. Markets don't price in things until they kind of really know what's happening. Did we learn anything new from Powell yesterday?
I don't think we did.
No.
On the neutral
rate? That's all I have to say.
thought that was interesting. The neutral rates are going to be higher than that period, post GFC.
I think there is. I think that has been built in. I've heard that from so many different voices now, that the R-star, the neutral rate, is higher. Ultimately, you can't bring rates lower, that much lower. He's kind of talking about the inflation narrative. Here is a guy that has been consistent over the last year and a bit, wanting to cut rates. Finally, he's got the evidence that maybe he can deliver upon that, despite the fact that he's maybe ignoring the PPI data. But this feels like a consistent message. This doesn't feel different to what the other Fed speakers have been saying over the last few days.
So I thought the PPI, I'm about 4 days late to this conversation, but the PPI data I thought was really interesting, because even though it came in, at least didn't come into a drop as in line with the CPI numbers that we got as well, the consumer loan data in the PPI just dropped off of a cliff. It was one of the worst numbers since 09. And I think that's really significant to me. I think you were talking about this in your show as well, is the fact that even though the markets are now pricing in potentially a September cut, Jan Hatzius at Goldman is saying, why wait till September? Why not do it this month?
Yeah, putting July in the cards in terms of protective cut. That's not being priced in by the markets. But Mark Cranfield from my own team was saying we shouldn't discount July as a possible opening for this Federal Reserve. And then Mark Cranfield also putting on the table, maybe if they go in September, they wait until September, maybe they go big, maybe they go 50 basis points to give them that clearance to that November election in the US, so they don't have to react ahead of that election and seem to be interfering. At least that might be the characterization. So the politics, once again, link into the central banking.
I think it's interesting we talk about central banking because so much of it was in the context of the election as well. And the idea here that the Federal Reserve may not want to step on the toes of what's going to happen on November 5th. There seems to be swaying it either way. Now, as you're seeing more policies in place from President Trump and starting to get kind of some wrinkles out of President Biden as well, a potential rent cap plan, for example. What does that then do to the fiscal policy? Is that something the Federal Reserve has to react to? That's going to be something we keep an eye on. In the meantime, let's go to get a little bit more context on the election story as well, specifically when it comes to not only the U.S. politics, but, of course, J.D. Vance and what this means in the broader electoral race when we're also dealing with the risk of Project 2025 in terms of what it means for the actual policy story. Lots going on. Who better to bring in than Bloomberg senior editor Bill Ferries. Bill, a pleasure to have you on the program. Look, there's a lot going on. Does this announcement change the dial from President Trump's campaign?
Well, we're going to find out in the coming days. I mean, J.D. Vance brings, I think he does bring a lot to the Trump campaign. The most important thing he probably brings is youth. I mean, both parties so far have been criticized for nominating octogenarians in this election. It's something that polls show Americans are broadly upset about. So at 39 years old, he is the youngest vice presidential nominee in about 7 decades. He brings connections, as you mentioned, to some of the more conservative wings of the venture capital community, the Silicon Valley tech community. And he also brings, I think, a life story of growing up in poverty to going to Yale and achieving some success that will resonate with many voters in a lot of those key swing states like Pennsylvania and Michigan. Now, the challenge is a lot of those people were probably already in the Trump camp. So does J.D. Vance expand the Trump margin at this point in the campaign? We'll have to see in the coming days about the reaction and how the rest of the convention goes before we really are sure of that.
Bill, what does it mean for China? What does it mean for Europe?
Well, I think there's a lot of overlap on the Trump foreign policy, not surprisingly. But, you know, you've heard J.D. Vance. He was a big opponent of that latest aid package to Ukraine. He was recorded in an interview 2 years ago saying that, frankly, he didn't really care what happened to Ukraine. So that will be an alarming sign for European and NATO leaders. He's said he wants to accelerate weapons deliveries to Taiwan. He's called China America's top enemy. So it'll be very interesting to see whether that really meshes with Trump if he wins that election. Former president known for wanting to make a deal, but has also called for very high tariffs on China. So in foreign policy, we're seeing kind of a doubling down on a policy that Trump has been articulating for years now.
When you focus on the Republican National Convention, then, Bill, where is your lens? Is it all about the Trump speech? Is there more that we can be looking for from this event?
Well, you know, there was a lot of speculation about Nikki Haley's speech after she got invited over the weekend after the assassination attempt. There was some thought that perhaps she would even be a vice presidential candidate for Trump at the last minute. She would, of course, bring a very different view of foreign policy as the former UN ambassador than what Trump has now. But her speech will be interesting to see in terms of whether she's able to kind of unite parts of the Republican Party that are still wary of Trump. And then, of course, as you mentioned, you have former President Trump's speech on Wednesday. He's promised a new tone. We'll see if he's able to back that up and what his vision is for the rest of this election campaign and the 4 years should he win.
OK, Bloomberg senior editor Bill Ferries, thank you very much indeed. Here's what else you should be thinking about coming up later on in the show today. With a preview for market analysis, we're going to have Catherine Neese, PGIM's chief European economist, and Seema Shah from Principal Global Investors as well to get the market take on all of these elements, the politics and the central banks. We're also going to be speaking to the CEO of Marathon Asset Management, Bruce Richards, which should be really interesting in terms of views on the credit space, private credit space, and how that's evolving. And for politics, we're going to be joined by US political communications expert Johanna Maska out of Los Angeles. And for the French, the latest on the French political turmoil, MP Philippe Brun. Here's what else Brun. Here's what else to watch out for today. 10 a.m. UK time, Euro area economic growth survey. So a build out in terms of the views coming through in terms of the health of the European economy, which is showing signs of a bit of a pickup, a modest pickup. 1:30 p.m. UK time. We're going to get that US data as well in terms of retail sales, really important. The Empire Manufacturing Survey as well, and import price index, but retail sales arguably the most important. 7:45 p.m. UK time. We're going to hear from the Fed's Adriana Kugler, who's going to speak at an event in Washington. And on the earnings story, we had Goldman Sachs. It was a beat coming through, even though the M&A part of the business did a little less well than many had expected. We're going to get more details, earnings coming through from Morgan Stanley and Bank of America as well. Net interest income and margins, of course, in focus. And that Republican National Convention, of course, the build-up to the speech by Trump on Wednesday. I wonder, Kriti, what stands out to you in terms of your interest, given everything that's unfolding over the next few days?
Yeah, there's a lot going on. So, of course, you have one eye on the Democratic camp as well. I think after the tragic assassination attempt on President Trump's life, a lot of the Democratic kind of rhetoric on pushing Biden out of that seat has cooled down quite a bit. Nobody really wants to take on President Trump right now in the face of the polling odds. From the Republican side, policy is really important because, look, President Trump is actually seeing a lot of pushing from some of the more right-wing slant of his party, which is kind of ironic given who President Trump is really appealing to around Project 2025. I don't know if this is something we've talked about on the show a lot, but it really has to do with a lot of very inflationary policies that are not inclusive of tariffs, domestic policies that would affect things like student loan forgiveness, housing, et cetera. Of course, President Trump has very outwardly said he's not really going to be leaning into that, even though it's been created by some of his former advisors. But it's going to be something that we watch closer to November 5th to see how much that changes.
It's going to be really interesting. Is it going to be Trump versus the Fed? and
it might be
how the Fed kind of deals with an inflationary impulse. Look, I think bank earnings are fascinating. Goldman Sachs yesterday quite strong, but in some ways the wealth division didn't deliver. It's going to be interesting to see what Mr. Picks, Morgan Stanley, delivers a little bit later on today. Fascinating to see that. The real story for me today, though, is going to be the retail sales number. How strong is the US consumer? What is going on with the US consumer? Are we seeing a slowdown? If you look at the University of Michigan data, quite negative, quite a worried consumer. And I'm wondering if that starts to get reflected in the real numbers.
The data is turning very quickly, and I think this is why policy matters so much, because how much does the sentiment change by what they're hearing on the campaign trail?
It links to politics, doesn't it? Absolutely.
Yep.
The consumer sentiment, the squeeze on retail, and the squeeze on the consumer, and how they're feeling generally about their prospects.
The relationship between inflation and, particularly in the University of Michigan data, the inflation and how the consumer is feeling has been really strong. And you fold the politics in on top of that, I think it's going to be a really interesting mix. And it's really divided down political lines as well. What else do you need to know? We've got a few other things that we need to be talking to you about. Let's talk about Salesforce. It's cutting around 300 roles, part of its broader effort to streamline operations. Sources telling Bloomberg the software giant made the cuts this month, the latest example of the tech industry reining in costs following years of rapid hiring. GM's chief executive, Mary Barra, walking back expectations of the company's electric vehicle program. The million number seems to be maybe fading a little bit right now. Mary Barra telling CNBC that General Motors won't have production capacity in place to lift and hit its previous target, that 1 million target, by the end of the year. And finally, let's move on and talk a little bit about what's happening with the European Commission downgrading its participation in informal meetings planned by Hungary, which holds the bloc's rotating presidency. The move comes after a similar decision by Sweden, Finland, Poland, and 3 Baltic nations. Prime Minister Viktor Orban's blindsiding of Western allies earlier this month with his visit to Moscow and Beijing certainly maybe behind that. And luxury China's challenge continues. That's hard to read. Cartier owner Richemont met sales estimates in the first quarter, but it was despite a slump in China. Sales in Greater China plunging 27% during the quarter, with Richemont's watchmaking division posting an overall drop of 13%. Luxury watches off the agenda.
There is a lot going on both sides of the Atlantic. Coming up on the program, Goldman's profit surges with Bank of America and Morgan Stanley next up to report out of the Wall Street Banks. We're, of course, going to have the preview. Plus, after yesterday's luxury rout, as I was just talking about, we'll see if there's more pain to come for the sector at today's open. But up next, Jay Powell says recent data may just be encouraging. We just talked about how it might be the exact opposite. We're going to dive into the details. If you have any questions, if you want to get involved in the conversation, shoot us an IB plus BB TV Go on your Bloomberg terminal. This is Bloomberg.
I would say we didn't gain any additional confidence in the first quarter, but the 3 readings in the second quarter, including the one from last week, do add somewhat to confidence.
Fed Chair Jerome Powell speaking to Bloomberg host David Rubenstein at the Economic Club in Washington yesterday. The market's getting close to pricing in 3 cuts now from the Fed, which I think is really interesting. There's been a real flip. The data's changing pretty fast as well, as we were just pointing out. Kriti making that point. Catherine Nice, Deputy Head of Global Economics and Chief European Economist at PGIM, Fixed Income, joining us now. Morning. Does 3 feel about right to you? Do you think it's 2? Do you think it's 3? Things are changing pretty fast, it feels.
They have. They've flipped around very, very quickly. I think the way the data evolves is going to continue to be really important. I think you mentioned earlier on the show retail sales. I think that's going to be key. The U.S. consumer has been very key in this cycle. Consumption in the U.S. has been exceptionally strong. If we compare that versus Europe, for example, huge difference. Even though in both of those economic regions, we now have inflation, pretty close to target. So I think that's going to be a key thing. I think for now, unless we see the U.S. economy really weaken markedly, I would still expect sort of limited and gradual cuts. But of course, if things soften faster than we expect, then it could be more aggressive.
What data are you looking at to try and figure out what's happening? I'm trying to join the dots and figure out what's going on. I listen to what the banks are telling me. the reports out from some of the consumer-facing banks, JP Morgan, etc., talking about the fact that they are starting to see delinquencies pick up. We're seeing data showing maybe consumer demand for loans beginning to drop off fairly quickly as well. That's one piece of the puzzle. Retail sales, I think, is fascinating as well. The consumers, though, still worried about inflation. You look at what is happening with the University of Michigan data. That fear is still there. So I'm wondering what you're looking at and what you're plugging in at the moment and kind of factoring as the most important bits.
I think there's really two things. One is you have to look at these more high-frequency near-term indicators, so things like surveys. The problem with those, of course, is they don't always give a very, very clear steer on exactly the trajectory that the economy is going to go on, but that's really all you've got. So I think there is a lot of attention on those, particularly if you think you're at a turning point. And I think, secondly, crucially, and it's not just in the U.S., you also see it here in the U.K., in the euro area, policymakers very, very focused on the labour market. I think a big reason why they've been able to be sort of very cautious and delayed in terms of these cuts is because of the resiliency in the labour market. I think if you see any hints there that the labour market is softening, that could potentially spook central bankers into being much more reactive, much more decisive, more aggressive in their rate-cutting path. If you don't see that, they can continue to be more measured.
How responsive do central banks globally, not just the Federal Reserve, need to be to the U.S. election, especially when we're talking about these long and variable lags, which could last anywhere from, I've heard, as early as 6 months in this cycle to as long as 18 months traditionally. Does Jay Powell need to have one eye on Trump right now?
I think this is very difficult for central banks. You know, again, we've seen it here in the UK. We've seen it in the euro area in the US. We have so many elections going on around the world. They've really tried to distance themselves from getting at all sort of embroiled and involved or to be seen to be having any kind of commentary.
But is that a mistake?
And I think what they're doing is they're really focusing on what is the macro data and on, you know, on their core mandate, which is achieving the inflation target. I think it's very difficult for any of us to anticipate what is likely to be the policy outcome of these election outcomes, which themselves are uncertain. So, you know, Jay Powell said this at the ECB forum recently, just stay focused on the mandate, inflation targeting, and just watch the data and not make a commentary. And that, to me, I think is the best way to preserve central bank independence.
It's interesting. We're seeing echoes of that in France. The FT reporting today the ECB is going to be reluctant to signal again where it goes next, given its focus on France and expectations that maybe additional fiscal stimulus comes through from whichever government is formed, and that could prove inflationary. So as we project out to 2025, whether it's the ECB, the Eurozone, and maybe more importantly the US, given expectations around Trump, if you project into 2025, the risks of inflation and a resurgence there, I mean, how long is this 2% target going to hold for a US economy that's looking at pretty stimulative policy in the event of a Trump presidency?
So, I mean, we'll have to see where we get to. I think there's two questions. One is, what do you think is the likely trajectory for inflation based on what we know now versus what's actually going to happen? Because between now and then, lots of other things that we haven't anticipated are going to occur. You know, I'm confident that central banks are very much committed to their 2% inflation target. They've done what they needed to do. They raised rates by far more than anyone anticipated. And inflation is coming down. I mean, it is within striking distance here in the UK. It is at target. So I think central banks just need to respond to the shocks as they happen. And in those moments when they look through, they understand that they have an option out, that if it gets hit by another shock, they're going to have to act more aggressively. And we've seen that.
Is the path to sequential cuts for the BOE clearer than maybe some of its central banking counterparts?
I think that's true for Europe in general. So UK and Euro area, I think the case for cuts is far clearer than it is in the US. Consumption is not strong. Investment, maybe less so in the UK. Investment's actually been all right recently, but in Europe, investment is very weak. Credit is weak to the real economy. It is far clearer that rates are in restrictive territory in Europe, including here in the UK, and therefore we can be more confident that cuts are coming.
Great analysis. Thank you so much. Catherine Nice, Deputy Head of Global Economics and Chief European Economist at PGIM Fixed Income. Thank you. Plenty more coming up, including our interview with Johanna Maska, CEO of Global Situation Room. Stay with us. This is Bloomberg.
I've seen pieces of it. I've not watched the whole debate.
And the reason I ask, because I guess the question is, are you all on the same page? Are you seeing what they saw, which was moments of, frankly, that appeared to be, you appeared to be confused?
Lester, look, why don't you guys ever talk about the 28 lies he told? Where are you on this? Why didn't the press ever talk about that? 28 times it's confirmed he lied in that debate. I had a bad night. I wasn't feeling well at all. And I had been, without him making it, I screwed up. It's not unusual. He's going to surround himself with people who agree completely with him. Have a voting record. I support him. Even though if you go back and listen to the things that J.D. Vance said about Trump.
That was President Joe Biden speaking to NBC News' Lester Holt, of course, in an interview in the last 24 hours. This, of course, comes in the context of Donald Trump recently naming J.D. Vance as his running mate as well. There's a lot going on in terms of what policies they stand for, in terms of how the polling is really playing out, especially in the context of that historic assassination attempt on President Trump's life over the weekend as well. Who better to bring us into a little bit more of the context and more of the analysis here than Joanna Maska, who is the CEO of the Global Situation Room and who previously served as the White House Director of Press Advance for the former President Barack Obama. Joanna, a pleasure to have you on the program. Look, I think the question a lot of people are asking here in Europe and around the world is how much of this rhetoric will actually come to fruition, whether it comes to tariffs, whether it comes to inflationary kind of impulses. When you hear about that 60% number or going tough on China or even pulling out of any sort of Ukrainian aid, how seriously is that being taken in the political community right now?
Look, I think we need to take everything seriously. It was interesting to see the Republicans, obviously the first day of their convention was pretty substantial because they announced JD Vance as the vice president. And JD Vance is relatively untested. I mean, just in 2022, of course, President Trump was calling him JD Mandel, which, of course, was his opponent's last name. He is someone who came to the scene because he wrote a beautiful book, Hillbilly Elegy, about his experience that actually was much similar to mine in Galesburg, Illinois, a town that felt kind of left behind, different in a way that he had a mother who had drug problems. He had quite the story, but he hasn't been so tested on a lot of his policies. So a lot of his policies are very populist. They're very different than the traditional Republican Party. You've heard a lot about the Republicans this week talking about unity now. But it was interesting just watching the convention because a lot of the things that Republicans have stood for a long time were kind of upended. I mean, if you saw the Teamsters president spoke criticizing the Chamber of Commerce, Business Roundtable, really going at them, saying that we need a populist, we need, American workers, we need American jobs, we need to work on these different things. And so it was a very different Republican Party, Republican platform than we've been used to. I think, the American voters are looking at both that and then, of course, comparing that to the Biden administration, the current situation with the Biden administration. And of course, there's a lot of, when we talk about unity, there's maybe not so much unity on the Democratic side either, because there's a lot of us calling for President Biden to pass the torch to a new generation. So it's a very dynamic moment in America. We're keeping it very interesting for the last 100 days of this election.
You're giving Europe and the rest of the world plenty to talk about, for sure. Joanna, I'm curious, and it's interesting that you talk about this kind of appeal to the blue-collar workers, and especially the book that he wrote, Hillbilly Elegy, of course, because one of the kind of political narratives has been that in picking J.D. Vance, President Trump is really trying to target the Rust Belt and the blue-collar workers that for so long have been such a big part of the Democratic platform and the Democratic base. But I'm curious how much pressure now moving forward within the Republican Party President Trump is going to face to put forward some of the prospects and some of the kind of plans within the likes of Project 2025. How does President Trump's policy agenda shift more to the right, or can it?
Well, if you look at the platform, I mean, it's got a lot of what they're talking about in Project 2025 in the platform. I mean, he's talking about the biggest mass deportation in America's history. There's not a lot on substance, of course, on how that would look to Americans, having, children's families children in some cases ripped out of our schools, seeing how that would even, what the costs are. Of course, there were a lot of children separated from their families before in the Trump administration without much of a plan. And still to this day, some of the children are not reunited with their families. There's not a lot on substance in the platform, but there are promises. And those promises, you know, he's made are very, like I said, they're very populist. They're, you know, anti-immigration. They're really focused on America. There are a lot of costs that come along with that, and those haven't necessarily been outlined. I mean, you talk about J.D. Vance again. It's just amazing to me. He picked someone. I mean, he's younger than I am. He's in his 30s. You know, this is a leader who truly hasn't been tested on the national stage. Last time, of course, he went with Mike Pence, who had decades of experience, had governance experience. And this time it's really someone who he expects to fall in line, but I don't know that he will, because of course JD Vance, before he was Trump's running mate, was saying that he was worried about Trump being Hitler-esque and other language that's kind of surprising out of your running mate.
Yeah, some really tough language there. And we should also mention, Guy, that President Trump has outwardly spoken that even though some of his previous policy advisors have created some of the policies around Project 2025, he specifically does not endorse it and does not support it at this time.
We'll wait and see, as you say, how things develop. Johanna, the election at this point, everybody seems to assume is a foregone conclusion, that Trump is going to win. Is that your view?
No. We've still got 100 days left. And there are a lot of people who have questions about Joe Biden, but have no interest in voting for Donald Trump. And I think we have to remember that those numbers are actually closer. And while, you know, certainly shooting is tragic, it should have never happened. It really surprised me as someone who's been at those events that anyone got as close as they did. It's not going to change some people's minds who have already made up their mind that Donald Trump is unfit for office. The question is, how many people are going to be motivated to vote for the Democrats? There's a lot of internal conversations going on. I mean, the cameras are right now on the Republicans. There's a lot of internal conversations going on with the Democrats on whether Joe Biden will be the nominee, if he's the strongest, who are our people who are going to be at the Democratic National Convention and really singing the Democrats' story.
Johanna, who should replace him? Who should, if Biden is to be replaced, who should it be?
We have so many Democrats that I would love to see an open convention with the likes of Wes Moore, who's the governor of Maryland, an excellent candidate, someone who has a lot of experience. I mean, he was a White House fellow, even in the Bush administration in the aftermath of 9/11, because of his military experience. He was at Robin Hood Foundation. He's been a relatively new governor, but he is not new to the government space. Also, I'd like to see Josh Shapiro, who's really dynamic in Pennsylvania. I mean, Pennsylvania is a key state. In fact, if Kamala Harris did get the nod and ended up debating Donald Trump, I could see someone like a Josh Shapiro coming in as her vice presidential candidate. And that would be very interesting to see a debate between Josh Shapiro and J.D. Vance. Gretchen Whitmer is an excellent governor of Michigan. She's brought together more of a centrist coalition. Again, the Republicans really, in their messaging last night, lost a lot of the people who had been traditional Republicans because this isn't what they believe. So those key people in Michigan are people Gretchen Whitmer has appealed to. I'd like to see, you know, in our open convention, people like Mark Kelly, who's a senator with significant experience, who is an astronaut, Gabby Gifford's husband. He could be very interesting. Ro Khanna. I mean, we have so many people. I'd like us to kind of turn it on its head and open it up.
That is a lengthy list. That's a lengthy list, and maybe that points to indecision. Maybe that points to the talent that's within this Democratic Party. But what gets us there? If you, as you seem to be, you're advocating for Biden to step down, for someone else to take over the mantle. What actually gets the Democratic Party? What gets Biden to that place?
Well, I saw him last week at the press conference, and I thought, you know, people were making a big deal of his mishaps, and I understand it. But I heard three things from him that I hadn't heard before. I heard him say, I know I'm the best to govern. I think I'm the best to win. And if my team shows me evidence that I cannot win, he would reconsider. That is very important. And then the next step is, what do Democrats do? Do they open up the convention, or do they open up for speeches to figure out who is going to be the rest of the ticket? The convention planning is going on right now. Of course, our convention isn't until August 19th. So we've got a little while. And as I keep saying, you know, if they need all hands in, there are a lot of us who are saying, you open up the convention, we're there for you. So I do think if they decided to do that, you could have a series of speeches, a series of votes. You could have the democratic process play out on television, and it'll probably draw as many eyes and probably won't be as personality-based as the Republican National Convention has been this week.
OK, Johanna Maska, thank you very much indeed. Really interesting insights in terms of the context around how the Democrats position and, of course, the meaning of this pick, the VP picks of JD Vance, what it means about the shift that's going on within the Republican Party as well. Johanna Maska, CEO of the Global Situation Room. Thank you. Coming up, we're going to look at your stocks to watch, including Cartier maker Richemont meeting its estimates with its latest sales numbers, but seeing a sharp slowdown in Asia. We discuss that next. This is Bloomberg.
Tuesday the 16th, 15 minutes to go until the start of trading here in Europe. Looks like we're going to be seeing a fairly negative get-go in around 15 minutes' time. There's a bunch of factors behind that, part of which is the legacy from the United States, part of which is some of the stock stories that we're watching here this morning. Politics can be probably folded in as well. Let's talk to our executive editor for markets, Mark Cudmore, get his take on all of this. Mark, let's talk about the broadening risk rally and whether or not ultimately that is a good thing or a bad thing at an index level. What do you think?
Well, this morning we're not seeing a large amount of that broadening the risk rally, but I do think it's a theme we can expect to see. I think it is a good thing. It's going to be problematic for some people because I think there's two parts to this. I think one is we're seeing Powell's dovishness is opening the door for easing around the world. That's why we're seeing front-end yields come lower generally. It's providing a more supportive environment, and it should also help to kind of keep the dollar capped and may even see the dollar soften, and that will be an easing of financial conditions. So I think around the world we can see risk assets do better. Another part of it, though, is rotation, which we've seen glimmers of last week. And I think we might see some more signs of that in this kind of earnings season. And I think it might be facilitated by what we're seeing coming out of Trump's kind of surge in the polls and the fact that he's now appointed JD Vance as his VP. He does have a history of fighting with big tech. Even if he's got some key allies in Silicon Valley, he's generally said he wants to break up some of the big tech. So I think that kind of theme of that new Republican momentum and what we're seeing from Powell and just generally what we're going to see out of this earnings season might facilitate big tech maybe pausing a little bit while the small caps catch up, value stocks catch up, the rest of the world catch up, and I think that'll be a good thing.
Mark, I want to come back to that Trump trade in particular. We're talking about the steepeners being the easiest, most direct play out of it, but how much of the roadmap in terms of the French bond market applies to what we might see in the U.S. bond market if at the core of both issues is a expanding and a quickly expanding deficit?
Yeah, I'm not sure I kind of like the idea that this steepening is seen as the ultimate Trump trade. I think that this has coincided with what's happening on the economic side. Powell and U.S. politics together are combining to help the curve get closer to disinversion. I know 2's 30s is already disinverted, 2's 10s hasn't yet. And I think that we can see that dynamic happening. And what's happening is that we are seeing on the monetary policy side, again, the Fed try to push that we are very close to starting the easing cycle. And that helps the front end come lower or at the very least be capped. On the other hand, we are having political policies from both parties that do not show a great concern about the fiscal situation, which should see long-end yields come higher. Now, if you combine that with what's associated with the Trump trade of like stirring growth and being good for the economy, well, then that may, and being pro-inflationary, well, that seems even more so that you should see the back end come higher. So yes, this is a trade which is working and tallying with the narrative of Trump surging in the polls, but I don't buy into the idea that this disinversion of the curve or this curve steepening is all about Trump trades in particular. It is the Trump narrative tallying perfectly with what we're getting from Powell, what we're getting on the economic signals. And do I think it's sustainable? Yes, I do think that overall in the second half we'll see that. And remember, it's when the curve disinverts that a recession looks imminent, and that's worrying.
OK, Bloomberg Markets Live executive editor Mark Cudmore, thank you very much indeed. Tying in, of course, the politics and the central banking to these markets with a focus on the US yield curve. Remember, of course, you can get up-to-date analysis and insight from Mark and the rest of the fantastic team there. Just go to MLive Go on your terminal. To bank earnings now, Goldman Sachs reporting better than expected Q2 results across much of the company's Wall Street operations. Goldman's earnings were 2.5 times higher than what they posted a year ago.
On the one hand, there's a high level of geopolitical instability. Elections across the globe could have significant implications for forward policy, and inflation is proven to be stickier than many had anticipated. On the other hand, the environment in the U.S. remains relatively constructive. Markets continue to forecast a soft landing as the expected economic growth trajectory improves and equity markets remain near all-time highs.
OK, David Solomon, of course, the CEO of Goldman Sachs. Let's get more then analysis and bring in Bloomberg's Jenny Serrain with the focus on the results from Goldman, but looking ahead as well to Bank of America and Morgan Stanley later today. In terms of the deal making, is there conviction now that deal making is back for these banks?
I mean, Goldman's results were just another kind of feather in that cap. So they really continued this trend that we've seen this quarter where, I mean, deal making looks really good. And so you've got these huge increases across the capital market side, across advisory. The one worrisome thing is that we do continue to hear from these banks. They aren't sure how sustainable this is. I mean, Goldman yesterday, to their point, they were pointing out that, you know, we're still a long way off from kind of the pre-pandemic normal amounts of investment banking levels that we might see. And so they still feel like we have a lot of room to run. That was a little bit different from the tone that we got from the likes of JP Morgan or Citigroup on Friday, who they were really asking, you know, we saw a lot of pull forward. We saw a lot of clients doing stuff in the second quarter that we expected them to do in the fourth quarter. That means we don't really know what's coming in the fourth quarter. So I think we're seeing a little bit of a debate right now in terms of, you know, how sticky this investment banking environment really is.
So that's the investment banking story. Then there's the consumer story as well. We got the PPI data last week that showed one of the biggest drops in consumer loans going back to 2009. And yet I haven't really heard any of the banks yet talk about that kind of drop. Might we see that in Bank of America today?
I mean, they're, I think, the second largest bank in America, so I definitely think they're a good window into how the U.S. consumer is faring. Something we have seen from a lot of these banks so far is that provisions are up pretty wildly, and so you see them kind of preparing for a potential souring of the environment. So even though you had folks like David Solomon just there talking about how constructive things are, how good he feels about the environment, a lot of these banks, when you actually look at what they're doing and when the rubber meets the road, as it were, they're preparing for downtimes and for tough times ahead.
What's the read across for Europe? Which bank should we be watching?
It's hard to say because I think we're in just such a different position. I definitely think, you know, Barclays, Deutsche Bank, BNP, all the normal Wall Street banks should see good investment banking results as well. But that consumer question, I think, is kind of an open-ended one here. And so it'll be interesting to see if things diverge or if they're all on kind of the same paths in terms of setting aside more provisions, you know, taking a close look at consumers with maybe lower credit scores and trying to kind of pay attention to that lower end of the spectrum.
Jenny, great stuff as ever. Thank you very much indeed. We'll look forward to the analysis of Morgan Stanley a little bit later on. Jenny Serrain on the banks. Let's talk about the stocks to watch. Let's start with the banks, actually. Jenny mentioning some of the names. I think NatWest, Barclays, Deutsche Bank, SocGen are probably on the list, BNP Paribas, all on the list in terms of the read across. What happens in fixed income, what happens in equities will have a direct read across, and people will analyse the Wall Street numbers from a European perspective. These stocks have had generally a really good run, with the exception of Krupa's SocGen, which, as you can see, year to date, still down 2% and trading on a pretty measly multiple right now in terms of the book value of that business, Tom.
Luxury was the biggest hit sector yesterday, of course, across the European sector, and you saw losses of around 15-16% by the end of the close for the likes of Burberry. Swatch also hit with their exposure to China. Burberry, of course, ending the dividend and changes at the top, but also facing a China problem. Richemont coming through and reminding us that China remains soft for parts of this luxury market, but they did see some pretty decent numbers in terms of Europe and the US, and so that has, to some extent, offset the losses that came through from the Asia part of the market with that focus, of course, on China. Year to date, that's the stock price move for Richemont, currently up 18.4% year to date. We'll see how that adjusts on the back of that update from Richemont. Let's have a look at Hugo Boss as well, because this could be quite a substantial mover to the downside, lowering its full-year outlook. The German clothing producer citing the impact on demand from persistent macroeconomic and geopolitical challenges and flagging the weakness in key markets. China, yes, but also the UK as well. That stock down 40% year to date. And let's flip the board and have a look more broadly at some of the names that remain in focus for us across this luxury space. We talk about the travails of Burberry yesterday and the hit to Swatch as well. Kering and Richemont in focus for us today. So we'll see how the luxury sector adjusts to the latest earnings, but certainly it is a challenging time, it seems, for this luxury space. And, of course, the read across to the CAC 40 and, more broadly, European equities.
Well, you mentioned the French index there. Let's talk about another French company, Sanofi, as well. The drug maker has set today as the date for the submission of its offers for its consumer health division. That, according to a French newspaper, I'm not even going to attempt to pronounce, but if you guys want to help me out there. Lesico? Lesico. Okay, I tried. I have to cushion it with the poor pronunciation. But they have two scenarios basically for the sale of the unit, either to retain about 30% of the capital or 50% of the division. Net, it's about 5 billion euros in sales. So we'll see if those numbers prompt some sort of move at the open.
Yep, the market open is almost upon us. We've got around 5 minutes to go until the start of trade here in Europe. We'll be watching that carefully.
It's a split, isn't it? It's a divergent picture. European equities are diverging from the US story. US is not far from record highs again for the S&P. You saw financials doing very well, energy doing very well yesterday.
Yep.
European futures pointing lower by 0.7%. We have the market open coming up for you in just under 6 minutes' time. Stay with us. This is Bloomberg.
Tuesday the 16th, good morning. 2 minutes to go until the start of equity trading here in Europe. Let's talk about the legacy versus where we are in the United States. So we actually came through. The blue line here is the European session. We closed down here. The US then fades as the afternoon progresses, which is interesting. That is maybe why we're seeing some negative future stories developing here in Europe as well, Tom. We've also got some of the luxury stocks. Going to be interesting to see how they trade today. But the broad legacy out of the United States, not particularly positive. We kind of went out at session highs.
Well, futures, as you suggest, pointing lower here in Europe, and quite substantially so, down 0.7%. I think that's significant given the sell-off that we saw yesterday across the European benchmark. The Stoxx 600 ending lower by more than 1%. And luxury, of course, that sector was the key drag, given the concerns about the likes of Swatch, of course, and Burberry. Currently, you're looking at further losses of 0.7%. FTSE 100 futures pointing lower by 41 points. And over in France, the CAC 40 down 0.5% as we focus back in on the politics of France and that debate around how to form a government in that nation. Kriti.
Yeah, and a big part of that is going to show up, of course, in the banking sector. We know in the fallout of the geopolitical fallout there that we saw so much of the banking sector took such a beating. Your SocGen, your Credit Agricole, the others. Do you start to see some sort of more sustainable rebound that we're keeping an eye on? Also, as they square us with some of the moves and some of the insights we're getting over from Wall Street as well, what's the read across from the likes of JP Morgan, Morgan Stanley, and of course Bank of America today as well? JP Morgan, of course, already talking about some of that global resilience that you are seeing. So that's going to be one of the companies. Luxury is, of course, another one that we have our eye on, specifically when it comes to the French index as well. Richemont, Hugo Boss, Guy, all on the agenda.
Absolutely. Right, here we go. The opening trade almost upon us. In fact, here it is. Time for the opening trade. European equities are called lower this morning, and that's what we're seeing at the get-go. As you can see, some red on the screen already starting to develop. The legacy from the United States, probably one of the prime drivers of this. But the FTSE 100 down a little bit this morning, only down by 0.2%. The DAX is down by 0.2%. Interesting to see how the CAC 40 opens this morning as well. The luxury story very much centred on the French market. French politics obviously a factor as well that we need to be thinking about as well. The chaos continues. When do we see some resolution on that? We'll get an update later in this hour. But as you can see, we're down as expected, as Tom was pointing out, by around 0.5%. That's the initial read. We are getting a CAC trade. There you go. It's down by 0.6%. So a little bit of underperformance maybe coming through there. The IBEX a little bit softer as well. So that's the market story that we've got thus far. Kriti, let's talk about Tom, let's talk about kind of where we are in terms of the deeper dive into these markets.
Yeah, so across your sectors, interesting, of course, we had that focus on luxury, and that remains for us. At the bottom of the list, though, today, it's basic resources as a sector down a full percentage point as things stand. So you're seeing that, of course, ripple across the UK markets, with the FTSE 100 down 0.4% because of the component around basic resources. Energy softer as well, down 0.6% on Brent, so that's tying into the energy story. And what's feeding into basic resources as a sector under pressure is the softness in iron ore prices, down 1.5% in the session. The most resilient sector, actually, despite that softness that's coming through on Brent and WTI, is energy, currently down 0.2%, but the least badly performing sector so far. The CAC current, with the focus there, as Guy was saying, unpacking the details around the politics, but also luxury when it comes to the CAC current. That French index currently looking at losses of currently around down 0.7%. So the leading loss maker across your main indexes across Europe.
It feels like some of the heavyweights are dragging the Stock 600 down, at least. When you're looking from an index contribution level, your ASML, your Novo Nordisk as well. I'm stepping on Guy's sensational 6 here, but even the LVMH and SAP as well, AstraZeneca, basically all the heavyweights that we traditionally look kind of driving the gains to the upside, moving instead to the downside. I thought Rio Tinto was interesting. You're seeing a lot of heavy volume there in terms of individual movers. And then we see the banking story to the upside. HSBC, for example, one of your biggest movers to the upside, one of the biggest contributors to the upside. I'm curious how much of that leadership really even stays throughout today's session and into tomorrow.
The breadth is extraordinary today. So you got, on the Stock 600, you've got 518 stocks down this morning.
Yeah.
And you've got 65 that are trading up, which is really interesting in terms of kind of how the mix is working here. There is this idea that we're going to see this slightly sort of broader market at the moment, which doesn't feel like what we're seeing certainly today. But there is also this idea that if you move out of the big heavyweights that you were just discussing and you broaden the rally, that's a good thing. But in some ways, I wonder whether that's true. These are areas that have really struggled. If people sell out of the big heavyweights, does the market go down on the back of that?
That's what I want to ask, actually. What is this trade-off that you're seeing in size, but also, is this just cashing out ahead of the European summer that I hear lasts like 6 weeks in the side of the Atlantic?
Not in the UK.
Not in the UK, in theory, or in principle at least. When so many people are leaving kind of their trading desks, you're seeing that light liquidity and volume going into August. How much of this is going to be kind of that just seasonality kicking in?
Yeah, I mean, that's certainly a factor. Look, luxury was still, I don't know, does Hugo Boss, I guess it does count as luxury, doesn't it? It's certainly not something that Guy Johnson would reach for, given his Hermes backdrop and wardrobe. But Hugo Boss is taking a big hit in the session. It's currently down 9.6%. They've scrapped their outlook. They've cut their full-year outlook on weaker demand. And interestingly, they flagged not just China, but weakness in the UK as well. But to the macro now, in terms of expectations around those cuts coming through in September, what we've been hearing from Jay Powell speaking to Bloomberg. Take a listen to Jay Powell as he talks about that increased confidence that they are getting closer to that 2% target.
On inflation, in the first quarter, we didn't make any more progress. The second quarter, actually, we did make some more progress. We've had now 3 better readings, and if you average them, that's a pretty good pace.
Fed Chair Jerome Powell speaking to Bloomberg host David Rubenstein at the Economic Club of Washington. So hearing there from Jay Powell, Guy Johnson's not convinced that he said anything new. I think his line on the neutral rate in terms of interest rates was interesting. The fact that he reiterated the balance of risks switching, or at least becoming more balanced, so inflation and jobs in line in terms of the importance for this Federal Reserve with their dual mandate, of course. You would point out that they've reiterated that. That's a reiteration of what we already heard. But I think it was interesting, crystallising some of those positions as we lead up maybe to the September cut.
He wants to cut.
Yeah.
But is it 2 cuts this year or is it 3 cuts this year? The market's kind of swinging back towards the idea that maybe we've even got 3 cuts potentially coming through this year. Is that a market positive? Is that a market negative when you think about risk assets? Maybe he's signalling actually that we are seeing a slowdown. Is the soft landing still on? How constructive can you be about these markets? Seema Shah, Chief Global Strategist, the Principal Global Investor, sitting next to me. Let's try and answer some of those questions. Are rate cuts good for risk assets?
That's a great question, actually. You'd think that almost it should be, but it really depends what that backdrop is.
Yep.
So let's say that they can do the timing perfectly. It's almost preemptive cuts before there's an economic slowdown really starting to come through. Then that should be positive for risk assets. If they're late to the game, though, and they're actually starting to cut fairly aggressively because unemployment rate is rising, well, then that's going to be a negative for risk assets.
Where do you think we are?
I think that we're in the point where if they can start cutting by September and do it at a gradual pace, then I think they've got the chance of achieving that soft landing, that unicorn soft landing, and in that circumstance, and risk assets can do fairly well. I don't think fairly well.
Define fairly well.
Right, so I don't think that you're going to see anything like what we had in the first half of the year or 2023. Valuations for those mega caps, they are very, very frothy. I think they will continue to do okay, but probably not enough to propel the market further, significantly further. So I think we're thinking about eking out a few more gains for the rest of the year.
Yep.
But the good news is, to your point before, is that you should see a broadening out of this performance. So it's not just about those mega caps, but actually seeing some of the other sectors, other companies really starting to join in with that rally. So actually a lot more opportunities for investors.
Where do you see this bond market factoring in some of the political risk? And the reason I ask that is because the equity market historically has been so sensitive to these kind of swings in the bond market. Is that the catalyst we're waiting for in terms of some kind of bigger potential move in the equity market in the back half of this year? Does it really come down to the bond market and, by extension, policy, deficits, all those scary words?
So I think the equity market is watching very carefully for how the bond market is going to react. So we've been, throughout this year, that kind of 5% level on the 10-year would always be a concerning point. Now, we're unlikely to get towards that point, and certainly as the Fed starts to cut rates, you should see Treasury yields skew lower. We know that.
Yeah.
The question is almost how much lower they're going to go. And as you said, if there's a narrative about fiscal discipline and that focus in an election year on what's going on with deficits, it's quite unlikely you're going to see a significant move lower in bond yields, which, of course, is a bit of a hurdle for equities in terms of moving forward a lot more.
But then you have these steepers at play. You had a bond freak out in the French debt market as well. It's the same issues that keep coming up. Add on the tariff potential to it as well. How much of what we're seeing in Europe serves as a roadmap for what we might see in the States? Is the size of the U.S. equity market and bond market, for that matter, is that a cushion for if we see a repeat of what happened in the French market, for example, or is it a magnifier when it comes to what we saw in the French market?
Yeah. So it's one of those questions that actually comes up year after year. When does the U.S. have to deal with their deficit? I mean, that is.
January 2025. That's when.
Right. So it's a continuous question that comes up. But the truth is that the U.S. is quite different to France, very different to Italy, the UK, where actually the US can get away a little bit further with increased spending. When you're looking at France, they don't have much movement. There needs to be something done about their fiscal discipline to make sure that they don't start leaking out too much. But I do think the US is in a slightly stronger position. It doesn't mean that you're not going to see bond yields move in response to that fiscal narrative, but at least you're not looking at crisis points approaching.
Seema, should investors be Trump-proofing their portfolios?
So look, typically, as you're going towards an election, there's always going to be volatility, and you don't make these knee-jerk reactions. And you generally see that the market should not respond to an election result. However, having said that, of course, you have to watch the policies, and we just have to look to when Trump came in 2016 and how the market responded. You have to start considering where do you want to have exposure. Now, you're already, and this is quite early, for the market to already be responding to the expectation of a new president. So we do think, when we look across the world, actually, the area that we feel is more vulnerable, and actually this is actually whether it's a Biden or a Trump, it's the rest of the world. It's not the US. So this is still a case of US exceptionalism. You think about trade tariffs, you think about geopolitics, defense spending, and unfortunately it's the rest of the world which probably needs a little bit of consideration from an investor perspective.
So how does that affect your regional bias then?
So we still have an overweight to the US, right? We have an overweight, for example, to the mega cap techs. We're not going to increase that exposure at these valuations, but we're certainly not going to reduce it. That's a long-term holding. When we look across the world, you're trying to figure out which ones are the least vulnerable to a number of different things. The election volatility with regards to Europe has been something which I think has hurt investor sentiment for Europe, which had just been returning. Parts of China, we're probably going to be keeping a slightly wary, cautious perspective on. But then when you look across to places like Japan and India, actually we think that they can continue to do well, even though actually from a valuations perspective, they're probably flagging a bit expensive.
Why is cap tech a core holding? Is it because it's a place to hide? Is it because it's a place that we're going to see continued growth from? What is it that makes it core?
So it's not that it's a place to hide. It's more that as we look out over a 5-10 year perspective, that is a secular trade that we want to have exposure to because of liquidity, quality, to your point of do you want to hide, but also over a 5-10 year perspective when, of course, there's going to be some kind of economic downturn, there's going to be a crisis at some point, those companies are the ones that should be able to
They're priced for some very good, strong growth for a very long time.
They are, but they are at the frontier of economic growth and productivity. So we do think they can continue to deliver. As I said, we're not going to be adding to exposure at this point at these valuations.
If the market broadens, does the index go down?
So, oh gosh, we debate this all the time. So yes, unfortunately, unless the other 493 companies can do incredibly well, and the mega cap tech are just kind of
ticking along,
then unfortunately I think the index could come down. Which is actually, look, this is why active management really starts to become important, because you have to be able to select which are the types of companies, which are the sectors, which are the regions, which could continue to do well, even as an index is struggling.
Okay.
Does the UK do well? I mean, the FTSE 350. I'm lifting from the MLive blog right now, but pointing out that they've outperformed. The FTSE 350 has outperformed its European peers since April. Expectations of a cut from the BOE in August. The stability that we have, political stability, and how we compare to France, Germany, and others. How does the UK perform? Do you want to be adding small and mid-cap UK companies?
So, yes, we do think you should be adding exposure to the UK for all the reasons that you listed. So we know that there's a central bank cutting cycle which is around the corner. We look at the economic backdrop and there's a cyclical upturn. We don't think it's going to go particularly far. I think it's fairly limited. But at least from a valuation standpoint, that improvement in fundamentals should be enough to sway investors. And then, as you said, the political stability impact is huge. You know, that's something which has kept investors away for the last 3 to 4 years. And now you are starting to see people talk about the UK in a slightly more optimistic tone. I think everyone's fairly reserved, but at least compared to what you've had in the last few years. And then, as you said, compared to some of the political instability which is forming in other parts of Europe, the UK almost looks like that safe haven, which is, I know, it sounds ridiculous.
Surprising.
No, we'll take it. We'll take that, I think. UK is a safe haven. Seema Shah, thank you very much indeed for the take there. US equities can continue to perform modestly if you get a cut. Still cautious on China. A little bit of caution as well around Europe. But the UK is a safe haven. There's the headline from Seema Shah of Principal Asset Management Chief Global Strategist. Do guys core...
Well, so the core six are really interesting.
Now.
So picking up on what Seema's just been talking about, this idea that these core stocks, we can put them up. These are the kind of stocks, these are the stocks that have been driving Europe. And Europe has been in some ways as concentrated in terms of the stocks that have been performing as the United States. And some of the names you got on the screen here have been those stocks that have been driving that. Novo Nordisk, huge impact. LVMH, you look at what ASML has done, Schneider's done. Schneider's part of the AI trade as well. These are the stocks that have lifted Europe and have done so in a really concentrated fashion. If you do start to see this market broadening and you do see these stocks not delivering that same level of outperformance and impact, does the index go down or up? And I think it's a really interesting question because in theory, you'd think actually the broadening is a good thing, but actually at an index level, maybe that doesn't actually happen. And you could see the same phenomenon developing on both sides of the Atlantic. Anyway, so kind of keep an eye on these stocks because I think it's going to be really interesting how they relate to the rest of the market. Luxury's been the key story, obviously, over the last couple of days. Hugo Boss down pretty hard today. So let's just take a quick look at how this sector's performing once again. Hugo Boss out with a full-year warning, effectively. That stock is being hit fairly hard. Richemont's numbers were OK today. The key takeaway, I think, from Richemont is that Asia underperformed. Watches underperformed, jewellery did well, and I think that's interesting. So Kering and LVMH both fairly flat today, but a big move down yesterday, and that's been compounded again today, you could argue.
Yeah, the bling is holding up for Richemont, at least.
How much did you guys contribute to that, by the way? Just out of curiosity.
Guy Johnson's all in on the jewellery and the Hermes handbags.
Those that haven't received my birthday or Christmas present just yet.
It's coming, isn't it, Guy? You committed to that, haven't it, on record?
I think.
Have I?
Well, we're going to find the transcript and give you the answer to that.
From something much more prosaic.
Well, do you want to do Ocado?
Oh, yeah, I'll do miners, but let's do Ocado.
Because miners, you get jewellery miners, the gold miners.
Yeah. You can't have robots in Ocado without miners because you need. Anyway, Ocado. Ocado. This is a volatile stock. Ocado. The stock is up 17% after raising its full-year 2024 EBITDA cash flow guidance as well.
I said so we have a call first thing this morning. I said I don't think Ocado is going to do very much today. I was absolutely wrong about that.
Jinxed it.
The 2-day doesn't even do justice to what we saw yesterday. So the stock got absolutely hammered yesterday,
right,
and is bouncing back quite strongly. It took a 3-day chart. I think I think it'd be interesting to see whether we fill the gap from yesterday.
It's a volatile stock.
We can probably find that out.
And of course, they've been building out their warehouses, the automated warehouses, and trying to build out that market share. But yeah, there we go, the gains. It's the top gaining stock right now across the European list. Is Ocado gaining around 18%?
So on a 3-day basis, it's up by 5.4%.
There we go. OK, that's the 3-day context, given the drop that we saw yesterday. The miners are in focus as well, given there's a little bit of pressure coming through for iron ore prices. Iron ore down 1.5%. Copper also taking a bit of a hit, down 0.4%. So iron ore or miners as a sector in focus for us today. A little bit of softness coming through for basic resources. It's the leading sector on the downside, down 1.3%, Kriti.
All right, so I think you've covered most of it, but there's just one more we got to keep our eye on. Wise is the one I've got a specific eye on. High by about 3.6%. Actually, one of your biggest index contributors to the upside on the FTSE 100. This comes after they're backing their full-year guidance. They also said that when it comes to the customer and volume growth, both are helping their income in the first quarter of fiscal 2025. So that, of course, helping the bottom line for Wise, and investors responding quite strongly to it, higher by about 3.6%. So now that we've got all of the stocks that are moving this morning, or at least the big ones that we're going to dive specifically more into the luxury space. Coming up on the program, Richemont defies a drop in watch sales and a slump in China sales to meet first quarter estimates. More on the luxury sector's struggles and wins coming up next. This is Bloomberg.
Welcome back to the opening trade. We are 20 minutes into your Tuesday trading session. European stocks down 0.5%. US futures are flat. We keep an eye, of course, on the luxury space, given the hit that came through yesterday. Richemont, though, coming in slightly better than maybe some had expected. It's in the red. Well, it's flat right now. Richemont is flat right now after first quarter earnings, which saw a drop in demand for luxury in Asia with a focus on China. But actually, in terms of the demand that came through from Europe and the US, slightly better. They did see strength in those regions. Let's bring in Andrea Felstead from our Bloomberg opinion team for the take on not just Richemont, but the broader luxury space, because it's been quite the few days, quite the week for luxury. Andrea, let's start with Richemont there. Is there resilience within this company?
There is definitely. The jewellery is really holding up much better than the watches. The watches are quite weak, but the jewellery continued to sparkle.
So those little Van Cleef kind of bracelets.
Exactly. They're so hot at the moment.
Or pendants, right?
Or pendants.
Yeah, everything.
Kriti's birthday shopping, I think.
Exactly.
I'm glad you know that.
It's been an unbelievable brand success, and Richemont are still rising. They've also got Cartier also having a moment. So they've got two really hot brands at the moment.
So you're hot. What is cool right now and what is not cool right? Because it seems to be having a really big impact just in terms of kind of what is driving these numbers?
Well, we've had this big swing over the last year from real opulence with Gucci to quiet luxury, which was very no logo, very sleek, muted colours, Brunello Cucinelli, cashmere. And that started to change.
Smiling.
That started to change a little bit. We're seeing the first signs that quiet luxury is coming to an end, and something a little bit more of a flourish, bit more feminine, that's coming through. So that's been a really big driver of brand heat. It also, you know, social media is a big driver. The Van Cleef bracelets and necklaces, massive on TikTok. So you've got all these factors coming through, which is affecting the luxury brands at a time when, you know, we're going from when it was absolutely blockbuster growth in the end of the pandemic over the last few years to a much more pedestrian level of growth.
pedestrian level of growth. How do you get the cool factor then back? You were talking to me in Daybreak earlier. You were talking about the fact that Burberry, and I'm quoting you, Andrea, I'm not putting out. You said Burberry has lost its cool factor. Do they need to sign someone like Guy Johnson to be the representative to re-inject into Burberry?
Definitely. They really need. I'm not in agreement with a lot of the analysts. I actually thought Daniel Lee's product was good. I thought it was a real step up.
It wasn't getting traction, was the argument.
It wasn't getting traction. Yes, it was a bit more expensive. Still not expensive compared to some brands. And yes, they did increase prices quickly, but they just didn't get that energy, that buzz about the brand that you had in the early days of the original, Gucci turnaround sort of eight years ago. And I think that was really what was missing. Quite a few people left the company, so perhaps they didn't have the marketing clout. But it was just that sprinkling that magic dust over the brand just never seemed to happen.
So I feel like I'm still catching up to the Burberry story a little bit and the change in C-suite, because that strategy still seems to be at play, where we're targeting the high-end customer. You're still trying to kind of upsell here. But if the money seems to be not in quiet luxury, it seems to be in kind of this more mass consumption vibe, for lack of a better term, this new person that they've put in charge is former Michael Kors, is former Tapestry, I want to say as well.
Yeah.
That's one thing Michael Kors knows how to do quite well, which is appeal to mass consumption. Isn't that a contradiction in the making?
Absolutely. He's got a good reputation, the Joshua Schulman, who's coming in as CEO. But this seems completely at odds with what Burberry's doing for decades. And yes, you can say perhaps it didn't work this time around, but also they didn't give the new CEO and the new designer much time. They've both been there around 2 years. And there were some signs that Burberry was getting a little bit stronger. We've seen some menswear influencers inject a bit of vintage Burberry into their styling. That's where it tends to start. And then you get the full brand picture comes in. There's a big question on whether Daniel Lee will stay. I think that's the biggest question now. He came in with a vision to be Britain's LVMH. Yeah. Now he's at a company that wants to be Britain's Michael Kors. That's very different for a top-end designer.
Why watch is slowing down?
Phenomenal growth during
everybody that wants one's bought one, basically.
Exactly. And again, it comes down to this brand strength. Cartier is having a bit of a moment, but in watches, Rolex still reigns supreme. Yep. Some of the other Richemont brands are doing quite well, but it's really that brand polarisation. And we've seen the secondary, lots of activity in the secondary market. Everyone's speculated on watches. That's come back, and that's showing not much sign of improvement, and that started to affect the primary market.
I can't contribute to the watch conversation much, but did you see at the Ambani wedding, all the groomsmen got like a blingy, I think it's a Tag Heuer? Tag Heuer watch, and it is
LVMH. Yeah,
exactly.
It was quite something to behold.
I think it was Audemars Piguet, which is.
I don't know.
I think I believe it was an Audemars Piguet, pink, rose gold.
Apologies, my mistake.
That's a level above Tag, because I got the invite, I turned it down, I was busy getting my hair done or something, so I missed out on that. But that would have been nice, wouldn't it? Otherwise, you had to walk. It's the pop swatch. That's what Guy went for back in the day. When you pop, you take the little. Do you remember you pop out the swatch? You take out the dial and you attach it to your shirt. I remember you doing that back in the day.
I genuinely have no idea what you're talking about.
Neither do I, really. Audemars Piguet.
Okay. Andrea, thank you very much indeed. Not sure where that was quite going. Anyway, we'll talk more about US politics next. That's the transition to make. Bruce Richards from Marathon is coming and joining us around the table. Looking forward to that conversation. This is Bloomberg.
Part that we don't know is what goes on afterwards from that direct link between the bank and the non-bank, how the non-banks are interacting with other non-bank financial institutions, or ultimately with the ultimate borrowers. We've been calling for, enhancing the reporting requirements, the disclosure requirements of this part of the sector, just to have a better assessment. I think the Financial Stability Board, beyond just the banking sector, looking at the global area and all financial institutions, will also start working on this. And I think it's a first step that we need to find out.
Jose Manuel Camper, Chairman of the European Banking Authority, speaking. to us a few weeks ago, talking about the idea that what he wants to see is a little bit more transparency. He wants to get a greater understanding of what is happening in private markets and the link back in to the banking sector. That was an interesting conversation, and one that I think we should take to our next guest. Bruce Richards is the CEO and chairman and co-founder of Marathon Asset Management. I used to talk to him all the time when Alex Seal and I used to present in the afternoons. We talked more about what was happening in the United States. He's got an office over here as well. So it's great to have you on set. Nice to see you, Bruce.
Thank you.
Thanks for joining us.
Yeah.
Look, there's so much to talk about. Well, I want to talk about those comments from Camper. I want to talk about what Jay Powell spoke about yesterday and his confidence about what's going on with the rate story in the United States. Let's kind of set the stage with the Fed story, first of all, and the kind of the broader central banking story. The market's getting towards pricing 3 Fed cuts this year.
Yeah, I'm been in a 2 camp, and so I think 2 is the number that I'm going to set with. But September seems to be a lock, and it's not only the Fed, but we have over here the ECB and B of A, Bank of England, that is all three actually trifecta, probably going to raise lower rates by 25 basis points.
So what happens to markets when rates start coming down in a meaningful way? When the Fed starts cutting rates, is it all clear in the commercial real estate market? Is it all clear in the regional banking market? Like, what is the effect of that?
So I think it'll be positive for regional banks, because I think when rates do start to come down, a more positive yield curve will be constructive as their borrowing costs come down. So there's no doubt in my mind that regional banks will benefit from lower rates. And as it relates to commercial real estate, that's a slightly different story. And the reason why it's a slightly different story is because the debt stack is just so large in calendar year 2024 and 2025 that there's going to be problems, because all these loans that have been extended and amended and extended into this calendar year, being pushed out in the next year, has to work their way through the system. So there's going to be an amazing amount of opportunity, I think.
Front-end rates come down. Isn't that a good thing?
Well, their financing costs come down a little bit, but you're talking about 25 basis points, another 25 basis points. It's still not much. There's going to be a couple pauses along the way, so it's going to take time. So number one. Number two is the term structure of interest rates are really important. So what's really important is what happens with 10-year rates, because the 10-year is how you price cap rates. And cap rates are simply going to determine valuation for a lot of these properties, in addition to, the cash flows you can generate. And so I think that real estate has a number of problems measured in the trillions globally. And here in Europe, the number's probably $1 trillion. In the U.S., probably a bit more than $1 trillion in terms of real estate property that's going to be transferred to new owners and the creditors before you work it all out. And that's going to take some time. That's a 2 to 3 year workout, so it's not just a quick fix. But I think as it relates to the banks, I think the banks are generally in good shape. They've been through the worst. And with their borrowing costs coming down, that's net positive.
A 2 to 3 year for that to all kind of trickle across. And that's just in that one part of the market. Walk us through what the kind of long and variable lags that Powell keeps referring to from Eco 101 sound like right now. Are we on the shorter end of that transmission mechanism?
Well, I think, speaking about the transmission mechanism, at the August 22nd Jackson Hole meeting, his whole speech, his keynote speech, is going to be about reassessing monetary policy and the transmission mechanism itself. And so that's going to be the keynote speech. And what he's going to, if he's going to be fully transparent with us, what he's going to say is, although the Fed still has its powers and the transmission mechanism works, it didn't work this time. And the reason why it didn't work this time as effectively is because simply the Fed waited way too long to start raising rates, number one. Number two, they continue to do quantitative easing for 6 full months after they started raising rates, which makes no sense, because you wouldn't want to do quantitative easing while you're tightening. That's an offsetting factor. And most importantly, fiscal spending was a bit out of control in the States, and all that stimulus on the fiscal side, which led to deficits, also negated a lot of the good work that the Fed was doing when they were raising rates. And so there are many other factors that also contribute, but those are the key gating factors that I think this time around negated some of that transmission mechanism. In addition to that, what we've also noticed is in the U.S., very different from here in the U.K., in the U.S., the home mortgage market is a fixed-rate mortgage market. And a lot of those folks had rates locked in at 3 to 4%. And so with rates locked in that low, homeowners didn't feel any of the stress at all from rising rates.
So you talk about that fiscal spend, though, and I want to come back to that. Of course, it's been a tumultuous couple of weeks, months, I'd argue, in U.S. politics. When we talk about what that shows up in terms of more kind of stimulatory policies, things like forgiving student debt, for example, from the Biden administration, or there's now talk about a potential rent cap of 5% from Biden administration versus something like spending more in oil or tariffs or kind of more protectionist policies on Trump. How does the Fed respond to something like that? Is it too early for them to start thinking about it?
Yeah, I think it is too early. I think clearly inflation is on a trend path back down to 2%, so that's great.
Unless the fiscal policy changes.
And I think it's clearly on that trend path, and I think it takes a while for trends to change. And so we'll have to see what the impact is. But, along the politics and the Trump trade versus the current administration, President Biden's trade, there's a very vastly different set of circumstances. A, with respect to tax rate, B, with respect to trade and tariffs, and then also with respect to regulations. But it'll be a free market, less regulatory environment under the Trump administration if he were to be reelected versus the current administration where Biden is, I think, very heavy-handed with respect to regulations.
So Trump is better for the economy, then? Is that what you're saying?
I wouldn't say better for the economy. I'd say the markets are probably going to respond more favorably. Okay. But it's very, very, specific. So you take a look at, less regulation for oil and gas, and that means a lot of probably pumping of oil and gas. It probably means a lower commodity price. So what is the investment that you make there? Yep. Probably in oil services. Probably oil services.
You're investing in oil services, Bruce?
Well, we're it's not necessarily, not right now, but I'm saying that's probably a sector market that would benefit where commodity prices itself might not benefit, despite, what is a favorable environment for oil and gas. So it's all very, very nuanced.
Bruce, you talked, and look, I'm paraphrasing, but in your answer to one of Guy's questions, so correct me if I'm paraphrasing it incorrectly, but I took from this, Guy said, is it the all clear once rates start moving down for parts of this credit market? You essentially said no, it's not necessarily the all clear. There's still pressure, there's still tension across some of these portfolios, but there are opportunities. You said there are opportunities. Where are those opportunities? Where are you going to be zeroing in on once those rates move lower?
So rates will move lower, but let's just couch it the right way. Yeah. So I think the Fed does, and ECB and BOE do move rates lower, but I think it's a step function. When the Fed started raising rates, they raised rates 525 basis points over 11 meetings with 11 successive meetings. When they start lowering rates, they'll lower rates once or twice and then pause. What are the policies that are coming out of government? Because they've learned the transmission mechanism can be greatly impacted by these policies, and they're going to measure that much more in a much more refined way this time around. And second, what are the stimulus impacts from lowering rates or the monetary stimulus that comes from that? Yeah. And so I think it'll be a very slow path down. And I think the R star will be permanently higher than where it had been in the last decade. And so what that means is a positive yield curve. Yeah. And it also means, I think, higher for longer despite rates coming down. Okay. And so I think the same investment opportunities that you've seen in the last few years will prevail in the next few years. Private credit markets are going to be a magnificent investment despite a lower term structure. But you might want to lean in towards some of the longer duration fixed rate paper if you think rates are coming down at the intermediate or longer end with a Fed loosening of monetary policy.
Are you worried that your image, your business, not your business particularly, but your sector is getting a bit of an image problem? I mean, quote with Jamie Dimon, for example, saying some of these things, private credit, not mark to market with the same discipline that we do. We've heard from regulators that the concerns, we had that sound. But how do you address those concerns? Is this Jamie Dimon envious at the role that private credit is playing?
I think this is Jamie Dimon, the brilliant banker and brilliant CEO that he is, wanting a little bit of the market share back, in the banking book where private credit has really stepped up. And I think private credit stepping up is such a positive thing because the circuit breaker when banks stop lending like they had in the past, when indeed, tighter monetary policy causes banks to pull back, private credit really stepped up in a big way and extended credit, keeping the economy moving, keeping companies' ability to access debt very fluid, and that's a very positive thing. Competition is good. And while Jamie and the bankers didn't have much competition in generations past, in the current generation, it's a very competitive market. The private credit markets are measured in trillions now. That's trillions less that the banks have on their balance sheet extending loans, and trillions more that private credit investors now can exploit and can capitalize for their clients.
So that's fair, and that private credit has filled the gap, but it's also created a little bit of liquidity crunch because there isn't. It's kind of wrapped up in private equity. You're seeing that with some of the hedge funds or some of the lack of buyout exits, for example. But I'm curious, one of the comparisons that Jamie Dimon made to bring it back to his banking perspective is to back it to the housing crisis pre-GFC, and the comparison he's making is that the deal structures itself are too complicated, and you see that in some of the private credit deals. And super return, people were talking about it. Synthetic financing, et cetera, and having more complicated covenants. Is that not a concern to you that sometimes this product may be getting too complicated in an industry that's growing too fast and seeing too much optimism?
I think capital structures are for companies to choose. I think providing these companies with the flexibility to choose their capital structures is what markets are all about. Private credit can allow for that to occur, allow for companies to have flexible capital. Is it complicated? Yes, which is why you leave it up to the pros.
Okay, you leave it up to the pros. I get that. Campus talking, the soundbite we played on the way in was, yeah, that's fine, but we just want to know a little bit more. We want some transparency. The private bit is the bit that seems to be causing concerns right now. Do you think Europe is going to forge ahead maybe slightly quicker than the United States in requiring that transparency, understanding the linkages?
Yeah. So let's distinguish transparency versus regulation.
Sure. So
banks are regulated because they take deposits, and they're regulated by the Fed, OCC in the U.S., by the ECB here, and so they're regulated institutions as they should be. And so the strength of their balance sheets are really, really important. Now, private credit, we are unregulated from a banking standpoint because we're not banks. We're not taking deposits. We're not guaranteeing, depositors a return. And so from our perspective, as long as we have the proper disclosure in our documents that our investors know exactly what we're doing, which they do, and we're fully transparent with investors, which we are, then I think working in a regulatory environment where the SEC or your regulatory authority properly regulates you is the proper regulation that already exists. Now, would we be welcome to another authority that tells us what type of loans we can make and not make? Of course, we'll do whatever the regulators require. Does that make sense in this case? Probably not, because we're unregulated banks. We're the private credit markets, and we do provide full transparency to our investors. Should we make even greater transparency? I'm all in favor of that.
On that note, Bruce, great to see you. Now I know you can come over here and see us. We're going to make sure you drop by and see us on a fairly regular basis. Fantastic update, Bruce. Thank you very much indeed. Bruce Richards, the CEO and chairman, co-founder, Marathon Asset Management. Coming up, we're going to turn our attention to what's happening in France. Macron's next move. France preparing for a caretaker government, with the left struggling to pick a premier after those snap elections last month. We're going to talk to a member of the Socialist Party. We're going to get an update on what is happening here and where this story goes next. We'll do that in just a moment. This is Bloomberg.
Welcome back to French politics now. French President Emmanuel Macron is set to appoint a caretaker government as the left Nouveau Popular Front struggles to pick a new premier. Macron is expected to formally accept the resignation of Prime Minister Gabriel Attal on behalf of the government later today. Let's get the view of Philippe Brun, a socialist member of the French Parliament, so part of that Nouveau Popular Front leftist group that, of course, came first in those parliamentary elections, though, of course, without that majority. Philippe, thanks so much for joining us. Where do things stand then in terms of building towards a prime minister? You've put forward, within the Socialist group, you've put forward a candidate that's been rejected, I understand. Her name is Laurence Toubiana. Where do we stand? When do we get a prime minister in France? What's the time frame? Who is the most likely candidate at this point?
Well, I think now the negotiations are quite blocked, and I believe that we will succeed in convincing our partners from the France Insoumise to accept Laurence Toubiana's name that has been also accepted by the ecologist and the communist parties. Laurence Toubiana is a former ambassador. She's a leading high civil servant in France with a huge experience, and she will be able to deliver our program. Now, I think we need to decide. You know, party politics is always very complicated, and of course there has been huge discussions in the following days. But I have to tell you that this discussion, they also existed in other countries. We've been elected for a week now. And let's see how many days David Cameron and Nick Clegg did take to make the Great Coalition in 2010. How many days the German Chancellor did take to make a coalition. So you know these discussions are always very long. But I think that in the end we will succeed in delivering a strong and stable government.
Philippe, in terms of that strong and stable government, then, there's a division, clearly. Your proposition for Prime Minister has been rejected, as you said, by France Unbound, part of that leftist New Popular Front group. And you're confident that that minister, that name, Laurence Toubiana, will be accepted. There are divisions now within your leftist group. Is it time for the Socialists, if your Prime Minister name, Laurence Toubiana, does not get accepted, is it time for you as the Socialists to think about forming a pact with Ensemble of Macron to start that outreach with Macron's party? Certainly the markets would welcome that.
Maybe, but we have not been elected to do that. We've been elected to deliver change. Emmanuel Macron did last election, and the electors, they asked for a deep change, and we need to bring about change in this country. So what we need to do is just bring about change, and we need also to find a majority in the National Assembly. I have here to remind you that we only have 190 MPs on a total of 577 MPs. So we need to pass agreements with other parties, and not only with the leftist parties, so that we can adopt a budget, so that we can pass reforms. So what we need now is just to secure a prime minister's name that is okay with every another party. And then we need to move beyond party politics and find a global agreement on what we need to do on the economics, what we need to do on fiscal issues, what we need to do on social issues.
Jean-Luc Mélenchon says that you keep vetoing, the Socialists keep vetoing his prime ministerial candidates. Is that true?
Well, I mean, we are talking about a veto from Jean-Luc Mélenchon himself on Laurence Toubiana's name. So at this stage, what we see is that there are strong discussions between us. But I think this is normal party politics, which is what is happening in every European country in the world when there is a hung parliament like this one. So we need just to wait. We need to keep the pressure down. We need to discuss, and I'm sure that in the end we will find the right prime minister, and I'm sure that in the end Emmanuel Macron will make the right pick. We need to hear what the electors did say last Sunday.
Are you hearing any names about who could be the finance minister? The financial markets are keen to find out. We want to know who the Prime Minister is going to be. We also want to know who the Finance Minister could be and what kind of policies we should be looking at, and whether or not things like pension reform are completely dead at this point. Give us an idea. Which names are you hearing, and what do you think about pension reform?
Well, I can't give you any name, but what I can tell you is that our will is to have a business minister, economics ministers, finance ministers that are able to deliver our reforms, but also to secure the funding of our debt, and to, of course, to make the country to secure our growth. And I want to tell you here that we, the socialists, and also the ecologists, the communists, the left in general, we did govern our country for 30 years in the last 100 years. So we are a governmental party, with several figures that are used to govern and make decisions. And I think that to that matter, no one should be afraid of the New Popular Front. This is, of course, a left-wing alliance. We are socialists. We want to bring about change. We want to make the minimum wage higher, and the minimum wage in France is lower than in the US and in Germany. Yeah. So we just want to make it the average minimum wage. You know, just look at the policies. It is not as crazy as you may notice it in the columns that I'm reading. The program that we have will need a strong backing in Parliament and will be negotiated with every partner so that we can pass bills and we can pass a budget.
Well, Philippe, speaking of that, I just want to follow on Guy's question. To be clear, does that mean pension reform specifically is off the table?
No, pension reform is not off the table. We are aiming to just basically cancelling, you know, the age 64 that has been put in the bill. We were elected for that, and there's a majority in the National Assembly to move this age barrier. The National Front also wants to move the age barrier. Most of right-wing MPs did vote against the pension reform in 2023. That means that we need just to lower retirement for people who started working at 18 or 20. But that doesn't mean that we will increase the pension budget, and we will find ways to balance the books. And I want to tell here that we are responsible people, and that there is no way that we will, increase deficits forever. We know that we need to reimburse our debt. We know that we need to balance the books, and this is what is at stake. But we also need social justice, and we also need to deliver for people who started working very early at 18 and 20.
Philippe,
it's not fair to, yes.
Philippe, it's good to hear that you want to balance the books from your mouth to the EU Commission's ears, because you the French government has to meet those new budget kind of deadlines in September from the EU Commission. You talk about balancing the books very quickly, just for time, 30 seconds here. Where do those savings come from by September?
Well, we'll have to discuss it in this hung parliament, and there have been several proposals made by different groups. We will need to study them, we need to discuss them. But I think there is much red tape in this country that must be tackled. I think there is some tax loopholes that must be clamped down. There are several issues on which we are working, and in the budget committee of which I'm partner, in this budget committee we have several proposals. So I think we will be able to deliver a budget that will bring about change, that will make social justice, that will make reforms, and I'm sure that we'll be able to balance the books in the end.
Okay, Philippe Brun, socialist member of the French Parliament, of course, talking to us about the developments as we wait a new prime minister over in France. We thank you so much for joining the program. Plenty more, of course, coming up today, including an exclusive interview with Emma Walmsley, CEO of pharmaceutical giant GSK, coming up in the polls at about 9:30 a.m. here in London. Plus, later, our U.S. colleagues, we're sitting down with David Malpass, former World Bank Group president and former undersecretary of the U.S. Treasury for International Affairs, as we wait for the policy implications out of the states and the continuation, of course, of the Republican National Convention. That does it for the opening trade. The Pulse is up next. This is Bloomberg.